recent years, companies have been judged on a number of metrics by shareholders, ranging from financial data to their views on climate change and gender equality. Insurers and reinsurers haven't escaped this trend either and are being judged on ESG factors. I'm Yvette Essen for AM Best TV, and I'm joined by Jessica Botelho, financial analyst for AM Best, to discuss ESG. First of all, can you tell me what are ESG risks?
Yeah, so let's first define what are ESG factors. So ESG stands for environmental, social, and governance factors. This is sort of a way to evaluate companies' corporate behavior and the impact that will have on their financial returns. As you mentioned in your intro, sometimes these aren't captured in conventional financial metrics. So it's important for companies as well as investors to think about their ESG risks and identify opportunities as well, and with the ultimate goal of enhancing financial returns. You asked about ESG risks. Well, this really varies by industry. We're obviously focusing on insurance, and the predominant ESG risk is related to climate change. The reason being, climate change can exacerbate the frequency and severity of natural catastrophe losses, which will impact, a company's operating performance, but also their balance sheet strength. Conversely, there are also ESG opportunities. So we define this as a way for companies to capitalize on ESG risks. And one example of that would be, again, thinking about climate change. Companies have actually now started to find innovative and new ways to create and develop new products that service the renewable energy sector.
We recently published a report looking at ESG in the insurance and reinsurance industry, and we've identified in that report how companies are embedding it into their practices. Can you highlight some of the examples of what companies are doing?
Sure. So in our briefing, we really focus on two areas where we've seen ESG integration. Those are the underwriting activities as well as the investment activities. Let's start with underwriting. So what's quite challenging for the sector as a whole is that there's a real absence of industry-specific guidance that an insurer or reinsurer can point to understand exactly what steps they need to take to implement this into their underwriting activities. So what that means is that the sector has really come up with various approaches. So for example, Allianz uses a systematic approach whereby they're implementing and considering ESG throughout each of the steps of the underwriting process. Underwriters are actually performing due diligence where they'll assess the ESG and reputational risks associated with a given policy. What we've seen more broadly in the sector is the term called negative screening or exclusion criteria. So it's kind of a blacklist of sorts that says we will not underwrite policies for companies that perhaps manufacture controversial weapons or operate in coal. So again, it's kind of a more straightforward exclusion where they've just drawn a line in the sand saying we're not going to underwrite those policies for those sorts of companies. The other area that we've seen is really in the investment activities. Now, you may have heard terms such as socially responsible investing or ethical investing. These terms have been around, and this practice of implementing ESG within the investment activities has been around for quite a long time. But really, we've seen it with asset managers more than insurers. Insurers have now recently been feeling more pressure from regulators, from shareholders, as you mentioned, and it's really requiring them to take a look at their portfolios and find an approach that works for them. What we've seen as being the largest one is negative screening. Similar to with the underwriting, we will not invest in companies that manufacture the controversial weapons, etc. So very, very sort of simple, straightforward approach to integrating this into the investing activities. There are other approaches, but that was definitely the most significant and broadly used.
In terms of ESG, how can it impact a company's credit rating fundamentals?
In our briefing, we look at each of the best credit rating methodology building blocks, being balance sheet strength, operating performance, business profile, and enterprise risk management. in short, all of those blocks can potentially be impacted by ESG. I'll focus on two. Let's take a look at business profile. What we found is that ESG-related scandals really have the potential to impact and elevate reputational risk. Let's say you have a scandal, and this is amplified in today's world where social media means that this can be communicated all over globally. What that may mean for your company or for an insurer is that their ability to retain and attract new customers may be compromised, and it could even impact their market share or market position. On the flip side, we've talked about the development of new and innovative products. So this can enhance your business profile as it adds diversification to your product offering. Another building block, balance sheet strength, can also be significantly impacted here by ESG risks. We've talked about climate change. The reason this risk is so fundamental is because the increase in severity and frequency of natural catastrophe losses will really test an insurer and reinsurer's ability to effectively manage that risk and ensure that their balance sheets are solvent to absorb those risks. The other point I wanted to make on balance sheet strength is really on the asset side. We've talked about how companies are integrating ESG within the investment strategy. This can change what the portfolio looks like. And just because an investment might have a good ESG rating by an ESG rating agency does not necessarily mean that it's going to have good credit rating fundamentals as well. So we need to understand how companies are considering both the credit quality of that asset as well as its ESG fundamentals. So overall, I think there's certainly the potential for it to impact credit rating fundamentals of an insurer, but you need to think about the materiality of that risk or opportunity as well as its relevance, because some of these ESG factors are also longer term in nature, and our credit ratings are looking at more short to medium term.
A copy of AM Best report looking at ESG and the role that it plays within insurers and reinsurers portfolios can be found on ambest.com. For AM Best TV, I'm Yvette Essen.